Hi, so today's topic is depreciation. This depreciation is charged on asset, and what kind of asset? Fixed assets, and that's too excluding land. Land is never depreciated, it is an appreciating asset. Okay, so it is charged on fixed asset, but fixed asset which is acquired or purchased and is used. On that kind of assets we have depreciation. Say for example, I buy a brand new car for rupees 8 lakhs. I use this car for say 6 months, and after that I want to sell the car. Do you know what is the price that I will get after 6 months? Is it 8 lakhs? Of course not. I will get less than 8 lakhs because nobody will be ready to pay me the same price. Why? Because I have used this car for 6 months. So I will get price less than 8 lakhs. So there will be what? Decrease in the value of my car, right? So this decrease in the value of asset is known as depreciation. So depreciation is the decrease in the financial value of an asset due to use, lapse of time, or when the asset become obsolete. This depreciation is considered as an expense by an accountant. Why as an expense by the accountant? This depreciation is considered as what? As an expense by an accountant in the business. Why it is considered as an expense? Because this asset gives what? This asset gives service to the business, and no service is received free of cost. There is cost involved with the service, right? So this cost is known as what? Is called depreciation, and this depreciation is therefore considered as expense of the business or expense in the business by accountant, and this expense is ultimately transferred to profit and loss account in order to find out true profit or loss of the business. Now, what are the factors to be considered in order to calculate depreciation? Factors to be considered. Number one, original cost of asset. Now, when we talk about original cost of asset, it includes purchase price, right? Plus any expenses related to this asset to make the asset ready for use. So what is the original cost of asset? Purchase price plus the expenses. What kind of expenses? Any kind of expenses incurred on this new asset in order to make this asset ready for use will be considered as the original cost of asset. Take for example the cost of a machine is say 1,50,000. Now in order to use this asset in your place, you have to incur some additional cost, like the cost of bringing the machine, that means transportation cost. So there is transportation cost, plus the machine has to be installed, so there is installation cost, right? So all these expenses when added to this cost will become your original cost of asset. Like say 1,50,000, transportation is 10,000, and installation paid is say 5,000. So the total cost of this machine becomes 1,65,000. So when you pass a journal entry for purchase of this asset, the value of this journal entry will be 1,65,000, right? Number two is estimated life of the asset. estimated life of the asset. Now, what is estimated life? The normal life of the asset. That means for how many years you are going to receive service from this asset, or for how many years you will be able to use this asset is the estimated life of asset. It may be 5 years, 10 years or 15 years. After that estimated life, the asset becomes useless and you have to sell it or dispose of. Number 3, salvage value, which is also known as scrap value, also known as residual value. Residual value or scrap value is that value which the owner of this asset will receive at the end of the life of the asset. That means when the asset becomes useless after its normal life and is sold in the market or is sold off, then the value or the amount received at that time is known as salvage value or scrap value. Like some of the assets will definitely have some scrap value, isn't it? Like say scooter, two-wheeler, cars, they will never have a zero value at the end of the life. They will certainly give you some amount at the end of their life, right? So that value is known as scrap value. So all these points should be considered while calculating or while finding the value, while finding the depreciation of an asset. Now we have methods of depreciation. See, there are several methods of depreciation, but here I'll explain only 2 methods which are there in the syllabus, and these are straight line method, which is also known as fixed installment method, or also known as original cost method. And number 2 is diminishing balance method, also known as reducing installment method. Okay, now let's understand the straight line method. Now it is a method of calculating depreciation where the amount of depreciation remains the same every year. Here the depreciation amount remains the same every year. That means the amount is fixed. Or the fixed amount is charged as depreciation. Okay, so that's why it is also known as fixed installment method. So the amount of depreciation does not change under straight line method. It remains fixed. How do we calculate? Depreciation under this method will be calculated by using this formula, original cost, which I have already explained to you, minus scrap value divided by life of the asset. Now in some cases life of the asset may not be there. The fixed rate of depreciation may be used. Fixed percentage will be given to you. Say the rate of depreciation is 10%. Rate of depreciation is 10%, right? And in that case, how do we calculate depreciation? We just replace this one. Life of asset is replaced with the rate of depreciation. So by rate of depreciation by 100. If it is 10%, 10 by 100, right? This is how we calculate if the rate is mentioned. Now say For example, here I give one example to show how to calculate depreciation under this method. For example, here the purchase price of a machine is say 32,000, is installation charges say rupees 8,000, and the life of the asset is say, estimated life is say 5 years. Okay, and then the scrap value of this asset after 5 years is say 5,000. Then how do we calculate the depreciation? Say here depreciation calculation. Then here you will have depreciation. Say first year, what is the purchase price? 32,000 plus the installation charges, that is 8,000. When you add, you will get original cost. So this original cost, so depreciation is calculated on the original cost. 40,000 is the original cost, right? So minus what? Scrap value. What is the scrap value? Minus 5,000. That is the scrap value divided by life of the asset. What is the life of the asset? 5, right? So 40,000 minus 5,000 will give you 35. 35,000 divided by 5 is 7,000. So this is the depreciation for first year. Now depreciation for second year will also be 7,000. So depreciation for third year will also be 7,000. For fourth year, 7,000. For fifth year, again 7,000. Right? So the amount of depreciation is not changing here. This is what we find. This is what we see here. So the amount of depreciation remains the same year after year. So this is what a straight line method is. Now we see the second method, that is diminishing balance method or reducing installment method. In this method, depreciation goes on decreasing year after year. So here the amount of depreciation keep decreasing year after year. That means the depreciation amount keep on diminishing, keep on decreasing. That is why it is called diminishing balance method. The same amount is not charged every year. Here what happens in this method, higher amount is charged in the beginning and the amount goes on decreasing thereafter. Okay, and here why is this depreciation keep on decreasing year after year is because the depreciation is calculated on the book value of asset. Depreciation is calculated on what value? The book value of the asset, which is also known as written down value. Now what is a book value? Book value is cost price minus depreciation. That's a book value or written down value. That means every year depreciation is deducted and the book value is calculated. That is the reason why the book value goes on decreasing, and since the depreciation is calculated on the book value, so the depreciation also decreases. Now the formula to calculate depreciation here, depreciation is equal to book value into rate of depreciation. Book value into rate of depreciation. Now let's take an example to understand this. Let's take the same example here. Purchase price is 32,000. You have installation charges, which is 8,000, and the rate of depreciation, say it is 20%. Then how do we calculate depreciation in this case? This is your depreciation calculation here. Depreciation and then the book value. For the first year, how do we calculate depreciation for the first year? For the first year, we need to take the original price, right, or original cost of the asset. Now, what is the original cost? The original cost of the asset will be the purchase price and the installation charges, because this is the expenses incurred on this asset. So here you have 32,000 plus 8,000. So this gives you 40,000. This is the original cost, and depreciation will be calculated on 40,000 at the rate of 20%. So into 20 by 100 will give you 8,000, right? Now, since the depreciation is 8,000 and the cost price is 40,000, we need to find the book value here. So book value is cost price minus depreciation. So 40,000 minus 8,000 gives you 32,000. This is your book value. Now this is the book value at the end of first year. This is also the book value in the beginning of the second year. So the depreciation is calculated on the book value in the beginning of that year, right? So the depreciation for second year will be on 32,000 on the book value. That is book value into rate of depreciation. So the book value is 32,000 into rate is 20 by 100. So gives you 6,400. This is the depreciation. Now, what is the book value? Book value is this amount minus 6,400. So that gives you 25,600, if I am not mistaken. Okay. Then depreciation for third year will be on this book value. So because this is the book value in the beginning of the third year, so 25,600 into 20 by 100, 5120. Then now the book value is this amount minus this figure. So you have 08. You have 21,480. Now the depreciation for third year will be on this amount. Similarly for the fifth year again on another book value. So this is how depreciation is calculated under the second method, that is diminishing balance method. Now what do we find here? Look at this depreciation amount. Is it the same? No, it keeps on decreasing. Why it is decreasing? Because we see here book value also keep on decreasing, and we calculate depreciation on the book value. Since the book value is decreasing, so is the depreciation. So this depreciation will keep on decreasing till we reach the scrap value. After reaching the scrap value, okay, and if still the assets are used in the business, then the depreciation of this asset will be nil, will be 0. That means we will not calculate depreciation on that asset because we have already reached the scrap value, right? So the asset will remain in the business at the scrap value, right? So this is the end of today's lesson. Thank you.